Stock options are contracts that give you the right to buy or sell shares at a set price. Let's break down how they work. At its heart, an option is simply a legal contract between two parties, not a direct ownership of the company's stock itself. Most standard equity options control exactly 100 shares, meaning price moves are magnified for the buyer and the seller. To trade options, you must track the strike price, the expiration date, and the premium, which is the cash you pay to enter the trade. Investors use calls when they expect prices to go up, and puts when they expect prices to go down. Unlike stocks, options have a shelf life. As the expiration date approaches, the time value of the contract usually shrinks to zero. Because options lose value over time, they are generally considered higher risk tools compared to simply buying and holding shares. Options can be complex, so take your time to study before risking your capital. Subscribe for more finance basics.